online. So what we're doing today is we're going to be doing Chapter 6. And before we go any further, if you're on a mobile device, this will not matter to you. But if you're on a computer, we now have a video feed. And so it will not record later. So the only way to see video is to watch it live. And so occasionally we will pick the video up and show you other parts of class. So I'm going to start by showing you what else. There are people here if you're online. Okay, so we have these. And I don't think you'll be able to really identify anyone. Okay, and then more importantly, right now, there's Brian and Haley. And then we'll go back here. How do you want that? Like that? Yeah. You can figure it out. Okay. So what to do this week? We have the Chapter 6 homework. We're doing Chapter 6 today and Wednesday. We have the attendance quiz covering today and Wednesday. And then we have the Chapter 7 videos on Sunday for the video quiz. Okay, new person in class. I've got her face on the screen, so she's behind the video and you can't see her. This is Haley. Haley and Brian are both going to be moderating this class session at 7:45 for a few weeks, and then presumably Brian will let Haley do it by herself. Haley is a senior accounting student. She took this class a couple years ago. We were just talking about we use WIMBA. So we didn't have the mobile or anything like that. But she took my class a couple of years ago, and she's also my student success leader for the last 2 years working with freshmen. And she also went to Europe with us, with Brian too. So, so I know Haley really well, and what I'm really excited about is not only is Haley going to be here, but she's tutoring for the class. So we now have tutoring for this class. And she is an excellent person to be tutoring because she's taken the class, she knows my accounting lab, she knows what's going on, and we are working together to plan the tutoring, and so she knows what's most important. And I have emailed out the link for tutoring. You sign up for specific times. Haley will be following up with you about your tutoring session, the location, etc. So check your email. But I sent an email. I sent a couple emails depending. You might have gotten 2 emails. You might have only gotten like 1. And I sent one of those emails was yesterday, Sunday. So check your email. Towards the bottom, there's a link for signing up for tutoring. And we are going to have sign-ups week by week. So you don't need to make a commitment for every week of the semester. If in a particular week you need to see her more, you can sign up for more times. Right now she has 6 different 1-hour slots available. And if you look at those times and you say, oh man, I absolutely cannot make any of these, email me and tell me a specific time that would work for you, a day and a time that would work for you. And I will work on making that happen. It might not be Haley. We might have someone else fill in, but we can make it happen. If you need the help, we are committed to getting you the help you need, but I need to know. But she does have 6 different 1-hour time slots, and if I have requests for a different day or whatever, we can adjust that week to week. So we're not committing. When you sign up, you're signing up for this week. Towards the end of this week, around Friday or Saturday, I'll send out a sign up for next week as well. So you just sign up week by week. So Haley will be moderating. She's in the moderating window right now, and then Brian will be here for a couple weeks, and then I think Brian's going to end up doing a couple tutoring sessions as well. But he's kind of excited maybe to not get up at 6 o'clock to get here. Yes, because he's coming from Canton. So so anyways, we're going to have some tutoring, but what's cool about this tutoring is that at this point, it would be Brian and Haley tutoring, and they're going to be in class. They know what's going on. So if you need the help, they are certainly here to help. Okay, so with that, we're going to start the chapter. Now, this chapter is, I think it's a fun chapter. That said, It's a little challenging, and we're going to start off really slow today. We're going to go through some really simple examples, and then we'll be able to use those examples as we go forward. Now, this chapter is one of those that we're not covering every single learning objective in the chapter, so we're not covering learning objectives 4 and 5. So we can just completely skip those. If we talk about any of that in class, that'll be what you need, but I don't think we are. I think it's just 1, 2, 3, and 6. Okay, so we're going to start out with some questions, and these questions come from the videos and from the reading. So first question is, inventory is an asset and cost of goods sold is an expense. True or false? Okay, so what do you think? At least you're not on camera. True? True? Seem pretty emphatic? Okay. I'm getting a bunch of truth. How about you down there, Brian and Haley? Yo? How many, do you have like a... Yeah, I was asking. 27 yeses and 2 nos. I had 100% truth. Yes, true. Okay, so this one isn't too bad, but you need to keep in mind inventory is an asset and cost of goods sold is an expense. It's one of the few expense accounts that doesn't have the word expense in it. Cost of goods sold is an expense account even though it doesn't have the word expense. Okay, so now we have another one. Okay, so inventory. So we said inventory is an asset. So assets are on the balance sheet. Now, inventory is presented on the balance sheet at the selling price of the item. Is that going to be true or false? Okay, so what do you think? False? Okay. True? False? False? Hello, good morning. As I just scare you? Yeah.
All the time.
Yeah.
False.
False? Okay. Ashley? False? Okay. Okay, so I've got a whole bunch of falses. I probably have more. Okay. No, no, I did not pull 25 people. Sorry. Yeah. Okay. So the answer is false. The reason it's false is because we do it at the cost of the item. And the emphasis is it's the cost of the item, not the selling price. So if we're selling chairs, and a chair we sell it for $100, but it costs us $50, it's on the balance sheet at $50. So we always show it on the balance sheet at cost. Okay, sales closely related to the last one we did. Sales revenue is based on the blank price of the inventory, while cost of goods sold is based on the blank of the inventory. What do you think? What?
D.
D as in
Dog.
dog. Okay. D as in dog. Okay. What about you? Okay. What do you think? You're not copying it. D? Okay. Okay. D? Okay. You think it's D? Okay. You have a breakdown for me, Brian? About 90% D? Okay, I have all D as in dog. Okay, and the answer is, of course, yes. We base, okay. We have sales revenue is always based on our selling price because that's what we're selling it for. And the cost of goods sold is based on the cost of the item. Okay, so now here's where we're going to start with some pretty elementary examples. But I want to get some abbreviations out of the way because this gets really long to write these out every time. So when you see BI, that's beginning inventory, EI, I use a lot, ending inventory, and then a very, very common abbreviation, even in the business press when you will read an article in the Wall Street Journal, they will talk about COGS, and that's cost of goods sold. Okay, so I just want to get those down because you're going to see these abbreviations as we go forward. Okay, so get it. Okay, so what we're going to do is we're going to walk through an example. And the example is very simple, but I want to concentrate on the concepts because the concepts here are not hard as long as you think about it. This is really hard if all you do is say, give me the formula, I'm just going to stick stuff in it. So let's think about this. Okay, so here's my inventory example. I'm selling shirts, okay? So I started with 3 shirts, and I bought 2 more. Okay, so pretty simple so far. We have 3, we bought 2 more, and so the question is, how many are available for sale? When we see inventory reports, we will see this number, available for sale. And available for sale in this case is going to be 5. It's what I started with plus what I purchased, right? So it's beginning inventory plus purchase equals how many I have available, okay? So that's not hard. Later on, when we put bigger numbers on it in the formula, it seems to make it feel harder, but that is fundamentally what we're saying. All inventory, all things we sell have to come from either beginning inventory, which is the 3 shirts, or purchased. They don't come from anywhere else. So we have 5 available for sale. Okay, so now let's say we sold 1. So we sold 1 shirt. It doesn't matter which one we sold. Okay, we just sold a shirt. Now, how many are left in ending inventory? So when we say how many are left in ending inventory, that's pretty straightforward. is going to be 4, right? Because we sold one. So we have just solved for ending inventory, right, in number of units. We had beginning inventory 3, we purchased 2, so we have 5 available for sale. We subtract the 1 we sold, and we have ending inventory of 4. That is fundamentally what we're doing in this chapter. That's how the formulas work. I think we lose track of that when we just jump in and go with big numbers. So this basic inventory calculation, I'm going to have a couple slides that I'm going to tell you, this is something you really need. This is one of them, okay? Our beginning inventory plus our purchases equals available for sale minus the number of units sold gives us ending inventory. And we'll tweak this formula, this setup a little bit as we go forward. But that's what we just did. We had 3 T-shirts we started with, we bought 2, we sold 1, we ended up with 4. That's it. That is the fundamental calculation in this chapter. Okay. Now, same example, but let's state it a different way. We started with our 3 T-shirts. We bought 2 more. Now let's say we have 1 left at the end of the year. So we don't know how many we sold, but we can solve for how many we sold because we know we start with 3. We bought 2 more, so we had 5. We have 1 left. That means we had to have sold 4. Now these numbers are really easy for us because we can get a handle on it. But these calculations are what we're going to be using as we put bigger numbers together. But these are the fundamental equations that we need in this chapter. Okay, so that's a basic setup. So now, the inventory calculation you just wrote, it also works. We can switch ending inventory and number of units sold, so we can solve for the other one. So this is just switching the bottom. And we're going to come back. You're going to see this on a slide coming up. So we can just twist around ending inventory and number of units sold. Now what I've been doing here, I've been working with number of units. But we can also do this with dollar values, and it works the same way. So right now I'm dealing with number of units, but we can switch over, and we will be switching over to dollar value. Okay, so that was one of them, one of the formulas. This is the other formula. So there's just on the same page the 2 things that you already wrote down. Oops, didn't mean to do that. Okay. So those are the 2 sets of formulas. If you know one, you can probably switch it around. So they're basically the same. The only thing that differs is the ending inventory and number of units sold or cost of goods sold. And we'll see this slide again, and we're going to use these formats over and over. So when we start tackling a problem, these are the formats we're going to come back to. We don't always necessarily calculate available for sale. We could do beginning inventory plus purchases minus ending inventory, but I put that in there because we use it enough that it becomes useful. Okay, so those are our basic inventory formulas. Now, let's do basic calculation. Let's assume T-shirts can be purchased for $10 each. So we're dwelling on, this is the cost of goods sold and this is inventory. Both cost of goods sold and inventory is valued at cost. So we don't need to worry about what we're selling them for. That's a separate thing that we do later. So let's assume our T-shirts can be purchased for $10 each. So that beginning inventory is worth $30 and the purchases are worth $20. Okay, so when we have that, our total available for sale in terms of dollars is $50. Okay, so now let's value the ending inventory. Ending inventory, $10 because we have 1 unit at $10. Cost of goods sold, we have 4 shirts at $10 each, so we have $40 in cost of goods sold. So what we have here is we have the $50 available for sale equals the ending inventory plus cost of goods sold. What we just showed there, where we have the available for sale, your beginning inventory plus your purchases has to always, 100% of the time, equal ending inventory plus cost of goods sold. It will always equal that. And that's going to be important to know as we go forward. Okay, so that $50 available for sale, the beginning inventory plus the purchases, equals ending inventory plus cost of goods sold. That is not coincidence. That has to be true. Okay, so, and that's really key, that the total cost of beginning inventory plus purchases will always equal the total cost of ending inventory plus cost of goods sold. Okay, right there is what we need. We've done just about all the calculations we need in this chapter with those formulas. And we've kept the numbers simple so you can see that it does work. Okay, so now we're going to start off with some really basic questions. So a company purchased 400 units at $75 a unit. The company sold 385 units. What's cost of goods sold? So take a minute and calculate cost of goods sold. Okay, what's your answer? Her answer is C. Do you have answers online, Brian? Okay, so we've got a lot of C's, and let me put that up there. So cost of goods sold is 385 units times the $75 cost per unit to give us the $28,875. Okay, so now, next one. Okay, same example, but now I'm asking what's ending inventory? Okay, so we purchased 400 units at $75 per unit. The company sold 385 units. What's ending inventory? What's the value of ending inventory? You have an answer. Yeah. Okay, we have the answer D here, as in dog. out of 20 B's out of how many? 23. Okay, well, I have 1 out of 1. Well, no, see, I have a big risk here. I could be 0 out of 1. Yeah. So, okay, so on this one, our answer is going to be 1,125. What you have to do first is you have to calculate what your ending inventory is. If I purchased 400, I sold 385, I have 15 left. We can assume that we have 0 in beginning inventory here because it doesn't tell us we have any. And we can't do this problem without beginning inventory if there were beginning inventory. So there's not. So we just assume there isn't. So we purchased 400, we sold 385, we know we have 15 left. 15 times 75 is going to give us that answer of 1,125. Okay, now you're probably wondering up to this point what we're going to do all week because that seems pretty easy. So right now we're going to complicate things a little bit. And this is why there's a whole chapter on this. Otherwise we could be done. Let's assume that the price of T-shirts, and by price I mean the cost of it, what they cost the company to buy, can fluctuate. So let's assume that the beginning inventory costs $10 each. But then when we went to buy more, the price went up to $15 each. Okay? So what happens then is that ending inventory, are we going to value it at $10 or at $15? Are we going to value the units we sold, the cost of goods sold, at the $10 or the $15? And that really is the issue in the remainder of this chapter. How do we value ending inventory? How do we value cost of goods sold? We know what the total should be. The total of those two, the total of ending inventory plus cost of goods sold, has to be available for sale. So it has to be the beginning inventory value plus the purchases. That has to be the total of those two, but do we value them at 10 or at 15? And that's what we're going to be answering in this chapter. So just to reiterate, you wrote these down earlier. This is one of those key important pieces of information, so I wanted to emphasize it again. These are the formulas we need for the chapter, and also we always need to keep in mind that our beginning inventory plus our purchases has to equal ending inventory plus cost of goods sold. Okay? All our inventory has to end up somewhere. We either sold it or we still have it. All of our inventory has to come from somewhere. We either started with it or we bought it. Okay. Okay, so moving forward then. Okay, we have 4 basic inventory methods. Now, the inventory methods, for the most part, a company makes a choice. So they decide which inventory method they want to use. There's 4 methods we'll talk about. The first one is specific units. Specific unit says our units are unique. Maybe they have serial numbers. Typically, they're high-cost items, and we can just track them. And this works fine for certain types of inventory, and I'll get some examples after we get through the 4. Okay, the next type of inventory is to say, well, let's just do an average. Let's average our cost and use that as our inventory method. And in that case, we take the total cost and we divide by the total units produced. I didn't write it up there, but that's important to note. We're going to take the total cost, divide by the total number of units we purchased or produced. So we're saying, here's the cost of everything we made or purchased. Let's divide by everything, the number of units that we made or purchased. Okay, the third item down is called FIFO, and that's first in, first out. So we purchase our inventory. The earliest units we sell are the earliest units. The earliest units we purchase are the first ones we sell. And then we have LIFO, which is last in, first out, meaning our most recent purchases are sold first. Now, with the exception of the first method, The first method, specific identification, we don't talk much about because it can only be used for unique items, probably with serial numbers. It is a real pain to account for specific units, meaning it's costly. It costs a lot to track your inventory on a item by item. So you're only going to do these when the cost benefit makes sense. You can only do it when you have unique items. So there I just put an example. An example of specific unit would be, or specific identification would be jumbo aircraft. Okay? You could do it with some other things, but that is the one inventory method that you can only use based on what your product is, because it doesn't make any sense. If you were talking about making inventory of Hershey's candy bars, there's no way you would do specific unit. You simply cannot. So specific unit, we don't say much in the rest of the chapter about it, because basically it says, well, here's these units. You know which ones you sold. You know which ones you still have. So it's just tracking the cost of those items. Okay, now average cost says let's take the total cost of everything we do and let's divide by the total units we purchased or made. Some products kind of have to use average cost, and that's going to be like, for an example, a cereal manufacturer. They don't have any way to track specific units, and that's just an example you can visualize for average cost. Every company can use any of the last three methods, okay? It doesn't matter what your product is. So I'm going to give you examples that help visualize the cost flows, but that doesn't mean a company has to pick it. A cereal manufacturer, in theory, can do the other two. But average cost, FIFO and LIFO, are methods about the cost flow assumptions that accounting makes and that we use in accounting. It does not reflect what's happening with the product itself. But so these next two examples I'm going to give you are to help visualize how these cost flows would work, but they don't have to be used with this type of product. Okay, so the first one, FIFO. If we think about FIFO, a product that would illustrate a FIFO cost flow would be milk. If you think about how they sell milk, they get milk in, they put it in the front of the dairy case. If they get more milk in, they put it behind the milk. So you are always buying the oldest milk. The oldest milk is in the front. That's a FIFO cost flow assumption. That's saying I'm going to take my first milk in and it's going to be the first out the door. If we didn't do that, if we didn't sell our earliest milk first, we would have milk spoiling. So we're always selling the first stuff in. So we're always selling that. Now keep in mind, we don't have to use FIFO for milk, but milk's a convenient way to think about it. Okay, next, LIFO. LIFO is last in, first out, so we're selling our most recent stuff. And the one that comes to mind on this one, that is a salt dome. So when they're selling salt, road salt, they sell road salt and they dump it on top. They make this giant pile. And as we get new salt in, it goes on top of the pile, and we get more new salt. And then when they use the road salt, they come and they're digging out the most recent salt. You can think of this also with gravel. So they're using the stuff on the outside of the pile, which is the newest stuff. That's a LIFO cost flow. Now, companies can choose between average cost, FIFO, and LIFO. Regardless of what kind of product they have, they're going to make the choice based on, certainly, tax implications. There are huge tax implications of all these methods, and we'll talk more a little bit on Wednesday about which methods companies would choose. Companies choose one method and then stick with it. They don't flip from one method to another. So they'll pick a method and they'll be in it, consistent with it. And if you look at any company's financial statements, it will tell you what method a company is using. This also, whether you use FIFO or LIFO, has a big impact on what you value things on your balance sheet on and what you value on the income statement. So this is, I found it's always challenging to remember which one's which. We're going to be using these in calculations. So FIFO, expense will always be the oldest units. Ending inventory or assets will always be the newest units. Under LIFO, our newest units are expensed or cost of goods sold. Our oldest units under LIFO are our asset value. So that's a good summary table, and you're going to see we're going to apply this over and over. Okay, so that's a good summary table. I would keep that handy because as we walk through this, and this will get, when I do this, I always have to think about what's happening with my inventory. Okay. So before we get into FIFO, LIFO, let's circle back to weighted average. A company has beginning inventory of $40,000 and purchases during the year of $110,000. Beginning inventory consisted of 3,000 units and 7,000 units were purchased during the year. The average cost per unit is do you have an answer? You're my sample of one. How many responses do you have? And what are we showing? Mostly C? Well, I have, yes, I have 100% C. Okay, so what we have here, it's $15. This is weighted average. So we're going to take our total cost, the $40,000 plus $110,000, divide by the $3,000 plus the 7. Okay, so we get $15 per unit. Okay, now let's start a little more challenging stuff. Okay, exercise 6.3. Let's just jump in. Okay, the first thing, we started March with an inventory of 9 sets of golf clubs that cost a total of $1,350. During March, they purchased 27 sets of clubs for $4,320. At the end of the month, they had 8 sets of golf clubs on hand. And the store manager must select an inventory costing method, and we have to tell cost of goods sold and ending inventory under all 3 methods. Okay, so notice that I have not circled anything yet, but I wrote the question, how many units are sold? Look, they tell you your beginning inventory is 9 sets. Our purchased are 27 sets. So there's our beginning inventory plus our purchase. So our total available was 36. And then it tells us we had 8 sets at the end of the month. Our ending inventory is 8. So how many units were sold? What we're going to do to answer that is we are going to take the 9 beginning inventory plus the purchase. So total available 36 minus the ending inventory of 8. So we will have sold of 28. Now, that is not unique to any of those individual methods. This 28 number, with this calculation you're seeing right here, we will use both for weighted average, for FIFO, and LIFO. So we're going to use it all through there. So we need to know 28. And I cannot emphasize 28 enough because later on we're going to try to remember where 28 came from. This is where 28 comes from. 28. Okay? Ending inventory, 8 units, sold 28. 8 plus 28 is 36, which equals beginning inventory of 9 plus purchase of 27. Okay? So 36. So we have 36 units we're accounting for. So that's generic material to all of these. Okay, so now we're going to start putting some costs on these things. So they're going to make us work for it. They don't tell us how much these golf clubs cost, but they told us that beginning inventory was 9 units at a total cost of $1,350. So if I take the $1,350 divide by 9 sets of golf clubs, that gives me a per club price of $150. Okay, so $150 is the purchase price, the cost of those golf clubs in beginning inventory. So then I'm going to do the same thing for purchase. I'm going to take that total purchase cost of $4,320 divide by 27 clubs, gives me a per set cost of $160. So now the challenge is we've got some valued at $150, we've got some valued at $160. So how much do we value ending inventory at, and how much do we value the cost of goods sold at, or the sold at? So what we do next is I'm just filling in the rest of my table here. I'm saying, well, the cost of my beginning inventory was the $1,350 they gave me. My purchase totaled $4,320. And then that total cost is the $5,670. Okay, so notice I have not yet got into A, B, or C. These are still generic computations that are going to apply to every method we use. So our total cost is $5,670. That's the cost of my beginning inventory plus my purchase. That total cost available has to equal the cost of ending inventory and cost of goods sold. Okay? And cost of goods sold, I put up the words sold units here, but that's cost of goods sold. So that $5,670, the question we're answering for A, B, and C is how much of that $5,670 is ending inventory and how much is cost of goods sold. So keep that in mind. These numbers, we're going to see them over and over. Okay, so average cost. Average cost, we're going to take that total cost, the $5,670 total cost, divide by 36 units. Remember, 36 units is the beginning inventory plus the purchase, and we get a cost, an average cost of $157.50 per unit. This is a weighted average cost, so we simply can't take the 150, add the 160, divide by 2. This is weighted for the amount that's in ending inventory, or in beginning inventory, and how much is purchased. Okay, so weighted, so A, the weighted average cost per unit is $157.50. Okay, so now ending inventory. We have 8 units in ending inventory times the 157.50 gives me $1,260. Okay, now we are trying to get ending inventory and cost of goods sold. So to get the cost of goods sold, there's 2 ways to do it. In this one, I have chosen to say 28 units times the 157.50 gives me $4,410. Weighted average unit method, or the average unit method, is pretty straightforward. It's pretty easy to use, but most companies don't use it. Most companies are going to use FIFO or LIFO. Weighted average can get pretty messy when you have lots of purchases, all different prices, then it goes over different periods. So it's not as simple as it looks right here in this example in real life. Now, to get my cost of goods sold, I could have taken $5,670 and subtracted out the $1,260. So if I've got one number, I can get the other. Okay, so let's go into FIFO. Okay, so now this is where it gets challenging, FIFO and LIFO, and working our way through. So FIFO, the thing to note about FIFO is ending inventory is the newest units. We can also tackle cost of goods sold first. We could say cost of goods sold are the oldest units under FIFO. That's what you need to keep in mind. So ending inventory is newest units under FIFO. So ending inventory are the newest units are the 27 units purchased, right? Because we have 2 sets of units to choose from. We have the beginning inventory at 150, and we purchased 27 at 160. So our ending inventory is the newest units under FIFO, so we're going to use the 160 price. So 8 times 160 is 1,280. So then the cost of goods sold then is I'm going to take the total cost, the 5,670, subtract my ending inventory of 1,280, and I get 4,390 as my cost of goods sold. So if I get either ending inventory or cost of goods sold, I can subtract from the total to get the other one. Okay, so that is FIFO. Now we move on to LIFO. So LIFO, ending inventory is the oldest units. You could also tackle LIFO by saying our sold units are the newest units. So ending inventory is the oldest units. My oldest units here, I have 8 units ending inventory, and my oldest units are the ones from beginning inventory. So my ending inventory is going to be those 8 units at the $150 cost. So $1,200. And then my cost of goods sold is going to be the total, that 5,670, subtract the 1,200 to give me $4,470 as the cost of goods sold. More than anything we do, I think, in this chapter, as long as you have it written down and you can apply it as you go, it's not bad, but you have to think through it. I cannot tell you how many times it's so easy to get caught up in which inventory methods which, and that's why if you have it written down and you're always saying to yourself, what's LIFO? And you here, LIFO has ending inventory's oldest units, and I can start with that end. Okay, so we have finished short exercise 6-3. That's not too bad, but there were a lot of calculations there that we had to do. So that's why they're not quick little problems. You do have to put a little bit of time in them. Okay, so let's do a couple questions now. So the first one, try it without looking at your notes, but then you can confirm in your notes. The FIFO method assigns the most recent inventory cost to expense. True or false? Okay, okay, fair enough. What do you think? Okay, okay. And you know what, when I first look at it, I don't know the answer right off the top of my head. I have to kind of talk about it. So just because I think that's a better way to do it than to, all right. It's so easy to get tripped up on this. You're saying false. Okay, well, let's hope that's true. I mean, let's hope your answer is correct. Yeah, let's hope you're wrong. Okay, so how many, do you have a lot of answers? A lot of correct answers? I'm going with my one sample of, we said false, right? I haven't thought about whether this is true or false. So we have a false here. You have a bunch of, go with false? Okay. Okay, you have a bunch of falses. Okay. Okay, so, and what I was saying is I don't know the answer to this off the top of my head. I can certainly figure it out. When I think FIFO, FIFO means the first ones in are the first ones I sell. That means my first ones in are my oldest units, and so I'm selling my oldest units, and so my expense is the sold. So this one's going to be false because my oldest units under FIFO are expensed. My newest units are in the asset. So that's why this table that I showed earlier, if you just want to confirm what you think, this table is very helpful. So we saw that earlier today. Okay, now we have, actually we're going to do a question like this coming up, but what I did is I took the question and I stripped out the bigger numbers, and so I made it smaller numbers, and we're going to talk through this one, okay? So this is a very, very good example of a type of question you will see. It can be multiple choice. It will be multiple choice here coming up soon, but this one we're going to walk through. So our inventory records show the following data. We have beginning inventory, 1 unit at $6 a unit. January 10th, we have 3 units at $10 a unit. And then January 22nd, we purchased more, 4 units at $5 a unit. Okay, and then we have, on January 31st, the end of the month, we have 2 units still on hand. What's the value of ending inventory at the end of the month if they use FIFO? So I'm going to pause for a minute, give you a chance to write this down, and then we'll resume in just a moment. Okay, so what we've got here, we use FIFO. So the first thing I do when I tackle these problems is write myself a little note saying FIFO means the oldest ones are sold first, the newest ones are still on hand. So ending inventory is going to be my most recent cost. So I have 2 units still on hand. So that means my 2 units are from that most recent purchase. So I have 2 units at $5 each. So the answer to this question is going to be $10. So what's the value of ending inventory? If they use FIFO, it's going to be 2 units at $5. So because ending FIFO means the most recent, the oldest ones are sold first, the newest ones are still on hand. Okay, so then we're going to continue with this example. Different question now. Okay, what's the value of ending inventory if they use LIFO method? Now this one shouldn't be bad either. We're just using a different method. So ending inventory now under LIFO. Okay, so these 2 units that are still on hand, LIFO means the newest ones are sold first, oldest ones are still on hand. So our oldest units, now remember we have 2 units in ending inventory. So one of those units is going to be from January 1st, the $6, okay? Now, we can't value them both at $6 because we only had 1 unit in beginning inventory. So for the other unit in ending inventory, we have to go get it out of the January 10th inventory. So our answer here is going to be $16. Okay? So that's going to be 1 unit at $6 and 1 unit at 10. That's because our oldest inventory was back on January 1st, but we only had 1 unit. We can't value 2 units when we only had 1. So we take 1 from January 1st and another one from January 10th. So when we're valuing inventory, whether we use FIFO or LIFO tells you which end to start at and to use the units up. Okay, so there is that one. Oops. Can you, not me, okay. Use your air. Okay, so now here's the real question, okay? So we have the following data records. So now we have beginning inventory, we have January 10th purchase, January 22nd purchase, and we have 210 units still on hand, and we're using the FIFO method. So I'm going to go quiet for a minute, let you write it down, but this should look very, very similar. So now see if you can come up with the answer here. Okay, on this one, so it should look very similar to the problem that we did, only the numbers are bigger. So 210 units, we're looking for the ending inventory value, and we're using the FIFO method. Okay, so FIFO means oldest ones sold, newest ones still in ending inventory. That is so important to write that down because it's going to help guide you on which end to start with here. Okay, so our answer here, 110 units at $11 a unit and 100 units at $10 a unit gives us a grand total of 2,210. I saw that on the three shoulders I looked over, the papers I looked over shoulders at. Okay. Okay, oh, and online too, Max, good answer, and Carly. Okay, so that's not bad. We started with very simple numbers and just added to it. So if you can do that, you're going to be able to reason your way through just about any problem we throw at you. So now I think I have another one here. New one, yep. Okay, so again, we have the same set of data, and now the only difference, so you don't need to recopy the whole question, the only thing that's changing is at the bottom. Ending inventory if they use LIFO. Okay, so LIFO means newest ones are sold, oldest ones still in ending inventory. So what we're going to see there, 210 units at $8. So we had the 210 in beginning inventory. We could take them from there. So the answer is going to be 1,680. I saw that in the chat window, so that's great. Okay, 210 units at $8 a unit, 1,680. Okay, so now we're going to leave that idea of FIFO and LIFO for a moment, and we're back into material from the chapter. The lower of cost or market rule requires a company to report inventories at the lower of what? So, A, historical cost or current sales price. B, historical cost or current replacement cost. C, current replacement cost or sales invoice price. Or D, FIFO cost or LIFO cost. I have not been up here this morning. Okay, what do you think? Oh, make it right so we can. Oh yeah, I do. Go ahead. Go ahead. Do you have one that's not? Can we eliminate one? What one do you want to eliminate? Okay. Do you have one you can eliminate? Or do you have an answer? I'll take an answer or eliminate. Do you want to answer or rule one up? B is the answer? Should I go with you as my person? You would not? Probably not. Huh. What about beside you? What do you think? So I have an A, so I can choose between the two of you. No, I have one. I'm choosing the first one. Maybe. Yeah, look at that. See, you knew what you were doing. Okay, I'll come back to you, and then you'll have a chance to redeem yourself soon. Okay? Maybe not today, another day, but okay. Okay. So the answer is lower cost to market is historical cost or the current replacement cost. How did we do online with that one? 19 B's, 2 A's. That's pretty good. Okay. Okay, so now we have a homework problem. This one actually goes pretty quickly. Not a lot of computations here. So, short exercise 6-7, that we're applying the lower of cost or market rule, okay? And sometimes it's abbreviated LCM. So it gives us a bunch of data, and it asks, and it tells us that under the box, it tells us the replacement cost of ending inventory is $49,000. What should they report for ending inventory, and what for cost of goods sold, and which financial statement? Okay, so first thing we're going to do, ending inventory. Now, ending inventory should be reported at the lower of cost. The cost for the ending inventory, historical cost is $65,000 versus current replacement cost. Current replacement cost is $49,000. So we select the lowest of those two, and our lowest is $49,000. So ending inventory will be reported at $49,000. And it's going to appear on the balance sheet under current assets. And the rule is lower of cost or market, market being the current replacement cost. Okay, so that one wasn't too bad. That was an ending inventory. Now, keep in mind, right now on our books, that ending inventory is valued at $65,000. We have replacement cost, we're saying we're going to show it at $49,000. So now we're going to do the next part of this question. The next part of this question is what should be cost of goods sold? It tells us in the table that they gave us that cost of goods sold is $420,000. But we need to adjust that by the difference between cost and market. And I'll show you what we're going to do here. Okay. So cost of goods sold, what we're going to do here, upper left-hand corner, $65,000, which was the historical cost, minus $49,000 the replacement cost. That inventory dropped in value $16,000 during the period. Okay, so that $16,000 has to be added to cost of goods sold. Okay, so what we're going to do on the right-hand side then is we'll take cost of goods sold of $420,000, add that $16,000 drop in market value, and get $436,000. That is our cost of goods sold. Okay, so cost of goods sold, $436,000. We're going to see cost of goods sold on the income statement. It immediately is below sales revenue. You will always, always see sales revenue minus cost of goods sold. Okay. Okay, so that concludes 6-7. I would love to do 6-15A, but I think we're going to run out of time. So what I want to end with is we'll start with 6-15A on Wednesday, maybe, or I'll put it online, one of these two. Okay, but just a reminder about what's due this week. We have the attendance quiz, Chapter 6 homework, and the video quiz over Chapter 7. One more plug is Haley, camera on Haley, is available for tutoring. Check your email from yesterday. You have to sign up for a session. So I will see you on Wednesday.